is Chuck Carville. I'm the Chuck of the Markets Up, Chuck. And my message today for Friday, the last day of the week, is really very simple. It's earnings seasons right now. We're seeing a lot of market volatility, and my blog was the stock market's bipolar. And the point of that is that it's almost maniacal. You know, one day it's up, one day it's down, and the idea that short-term stock price movements are really not important is critical, I think, to long-term investment success. So I'm simply going to review. I'm going to use three simple choices. I'm going to show a company, GenCorp, and I'm going to show how, in the long run, what's really important is how the business does. The blue shaded area here represents the normal price-earnings ratio of GenCorp. As you can see, earnings have been very erratic. They went from $1 a share up to $2.06 a share here. Then they collapsed all the way down to 96 cents, then to a loss. Then they had no earnings again, and they made a little earnings. As you can see, over time, the stock price, really correlates to earnings. And there are times when the market price gets wacko, it inevitably comes back to its earnings justified level. That's a very, very, critical factor. The long-term rate of return from owning a company like this is really not very good. This is strictly a trading sardine. You have to buy and sell this. You put $100,000 in this stock 20 years ago, it would only be worth $23,000 today. That's a compounded minus 7.1% a year during a time when the S&P itself would have grown by 5.8. In the long run, it's earnings that determine market price. My second example this morning is Fortune Brands, a very well-known company. I want you to see, once again, you have very erratic earnings, and you have a stock price that in the long run correlates to what the earnings of the company are doing. So, when earnings are rising, stock price is rising over long periods of time. Each of these represents a year. Then we have a period like we did in the recession where the stock price collapsed. The stock price followed suit also. So, once again, you got a situation where you didn't make any money owning this stock because the business really had very erratic earnings during the period of time. Then my final example to illustrate how important earnings really are is Teva Pharmaceuticals. I like this choice because here's a company that's, the leading generic manufacturer in the world. It's headquartered in Israel. It's actually an ADR. But I want you to notice the earnings growth of this company has been very strong at almost 25% a year. You can see the stock price correlates with that very closely. If it does get out of whack, it comes back to earnings. Whether it's overpriced or underpriced, stock price always moves back to earnings. The recession has taken its toll. There have been some acquisitions here that have caused a little bit of interruption of what I'd call a normal, strong upswing in earnings, but that's assumed to resume right now. And you look at, a 25% grower here, 24.8, $100,000 in this stock 20 years ago would have actually grown to $7,235,000. That's a 24.5% growth rate versus that 5.5. In the long run, it's the earnings that are important and not the daily volatility in stock prices. This is Chuck Carville. As usual, I'll be not blogging over the weekend. We'll talk to you again on Monday. Y'all have a great weekend, and thanks for listening and tuning in all week, and we'll look forward to talking again next week. Thanks.